I'm going to be showing you where you can buy property for £1 up to £20,000 in the UK. And I'm also going to be showing you why buying cheap, even with a high yield, isn't always desirable and some of the risks around this. I'm also going to be showing you why you need to do your due diligence on the area and the location that you're picking. I'm also going to be showing you how to analyze your location to decide whether it is a good place to invest or not. So believe it or not, you can actually still buy a property in the UK for £1. Well, that's if someone doesn't outbid you. Because of course, these low prices are actually driven by auction houses. And as much like eBay, they are setting the prices very low to drive interest and to drive publicity. So you will get prices around £5,000 or less, sometimes £1. And what that does is that drives leads and interest to that property, as well as gives them publicity, as you can see from all these articles showing various auction houses selling property at £1. But the reality is that the property won't actually sell for this, because as we know, in any auction, looking at eBay, for example, that guide price is only the guide price and it will sell for much more than that. However, even if these types of auctions do attract interest, there are still places where you can buy property for less than £20,000. So there are various areas like Hordern in the northeast, Washington in the northeast, Barnsley in Yorkshire, Hartlepool in the northeast, and Liverpool in the northwest. But the key question here is, would you actually want to buy a property for that amount of money? Just because it's cheap, does that mean it's a good investment? So the first question you've got to be asking is, why are these properties so cheap? One of the main factors is that these areas are considered less desirable, especially when you compare to the south of England, and therefore there is less demand to live there, and this affects property prices quite significantly. It's important not to tarnish all these areas with the same brush. So a good example is Liverpool. Even though we talked earlier about the fact that you can buy properties in Liverpool at auction for around £10,000, that doesn't mean the rest of Liverpool isn't a good investment area. In fact, it is one of the most popular investment areas over the last few years and is set to kind of continue that way due to the amount of investment going there and the high yields and high growth potential. So therefore, it's just important to do your due diligence to understand what the good and the bad areas are. And that's what I'm going to be covering later in the video. So there are still some good opportunities in these investment areas. It's just a case of understanding where they are. So you're probably thinking this is all too good to be true, and you're going to run off with your credit cards and try and buy one of these properties for less than £10,000 in one of these areas that I've mentioned. But is that the best idea? Well, in one word, no. And that's because these houses and areas are cheap for a reason. I've spoken previously that the best investment strategy, the strategy that we follow, is to buy in an up and coming area which has got high yields and really good growth potential for the future, and then to try and buy below market value. However, a key aspect of what is missing from some of these areas that I mentioned and where these cheap properties exist is the future growth potential. These areas are often underinvested in, and that is because they have poor economic prospects. This is often because an industry which dominated the area then closed. So for example, mining towns, the steel industry, the shipbuilding industry, and you see this in northeast, northwest, Yorkshire and Wales. That industry has been pulled, and essentially it provided so many jobs and was the dominant economy driver and employment prospects. And since those industries have closed, normally sort of in the 70s and 80s, those areas and towns have gone into disrepair and have never really recovered. And what this means is that it creates a snowball effect and a negative spiral, because investment gets pulled from private sector. The councils have less money to spend because there's less people living there, so there's less council tax. So they don't have the money to reinvest in the area either. The whole area just continues to fall into disrepair, it snowballs, and it just gets dragged down with sort of little prospects of recovery. And then this further compounds through a lack of jobs, a lack of investment, all means that these become less desirable places to live. That means the property prices plummet, council tax reduces, and then the spiral kind of continues. And this is what happened in Hordern Village, which is in the northeast, 12 miles south of Sunderland. It's an ex-mining town which closed in 1987 with a loss of 2,500 jobs. And this has led to a 30-year downfall in the town. It's actually estimated by the Empty Homes Agency in 2021 that 1 in 5 properties in the village were empty, which is a staggering amount. So ask yourself, as a renter, would you want to live there? Would you want to bring your children up in such a down and out town? And this is the way you need to think as an investor. You need to be picking areas which have strong rental demand, which are desirable places to live, which have good amenities, which have strong or growing job prospects. You want to be picking places which are desirable, where people can thrive, which people want to stay for the long term. And because they want to stay in those areas for the long term, because that's the pull factor, they will stay in your property for the long term too. Because if you look at properties within the Bronx, even though they are going to be cheap properties, even though they may have high yields, they are going to be the areas which we've kind of looked at today. So areas such as Horden, where that area has fallen into massive disrepair and it's going to take potentially 40 to 50 years to regenerate and billions of pounds of investment. And you've got to ask yourself, where is that investment going to come from? Is that even realistic to assume that that regeneration is going to happen? And if you were to invest in an area like this, in the Bronx at the bottom of the rung of our classification, you are unlikely to see any returns from capital appreciation in the long term, because there's going to be very, very little growth in those areas because of the lack of investment, because of the lack of job prospect within your lifetime. And as I mentioned, it's not even certain that those areas will even regenerate in time anyway. Plus, I think it's worth stressing that the type of demographic of people and tenants in these areas are very much likely to cause you problems because of the level of kind of poverty and often desperation in those areas. It is those tenants who statistically are probably more likely to not be able to pay their rent because they might be have low sort of job prospects or potentially be on housing benefit. You could potentially have problems with antisocial behavior, crime, damage to your property. These are the types of properties where you see people talk about them on Facebook groups, where they've been trashed, where damage has been caused, where they've had problems with payments and they've had to go down an eviction route, and it's all been very painful. These are the properties in these type of areas that are very much likely to burn you as a landlord and potentially put you off becoming an investor for life. And ultimately, this is because these areas are the wrong places to be investing in. You want to be looking at areas which have good prospects for regeneration and have investment planned over the next 5 to 10 years, so you can guarantee that you're going to start to see some growth over that period of time, and that will then snowball to and compound to give you a strong capital growth into the future. Hi guys, if you're enjoying this video, really appreciate if you could like and add any comments and any questions and subscribe to our channel. We're trying to grow it and really appreciate the support that you can give us. Thanks very much. So hopefully I've made my point that just because you can buy a cheap property, even if it's going to provide you a good yield, it's not necessarily going to be a good investment. And in fact, it's going to potentially be a costly investment and a potentially painful investment if, for example, you have trouble with tenants or crime in the local area. As I mentioned earlier, you can get good investments which are cheap. You just need to ensure that you're doing your analysis, particularly if you're buying at auction. In terms of the analysis that you need to undertake when looking at any property, but particularly a cheap property, you need to understand the condition of the property. You need to understand how much that refurb is going to cost. Is there any significant issues with that property, such as structural? You also need to understand the circumstances of the property. Why is the vendor selling? Particularly, why are they selling for a cheap price? Is there any legal issues with that property, for example, a short lease? You need to understand the location of the property. Which classification is it in? Is it in the Bronx? Is it in the middle class area? What is the rental demand in that area? Will it be a desirable place to live? What is the tenant type and demographics in the area? What types of tenants are they, and will they cause you any issues? What is the potential for capital growth in the area? What investments are planned? What regeneration is planned in the next 5 to 10 years? Because if you miss any of these steps, if you miss any of these points when you're doing your due diligence, this is when you can get really burnt. Because if you buy a property that's in poor condition, condition, potentially one that's may have structural problems, that's going to cost you a lot of money and going to cause you a lot of stress with a lot of headache. And another way that you can really easily get burnt is if you buy a property in a bad area where there isn't actually much rental demand. You could potentially end up with bad tenants, as I mentioned. You could potentially earn less rent than you were expecting because you've had to reduce the price because no one wants to live there. And the other thing is you might have quite a lot of voids because you might have a turnover of people because no one actually wants to live in that area, so they keep leaving, and therefore you're going to have more voids and they're going to have more gaps in your payments, and therefore your returns are going to go down, and just generally it's going to cause you a lot of headache. And a really good illustration of the pitfalls of not doing your due diligence and buying in the wrong area are that I know an investor who we've worked with before who once tried to buy a property which they hadn't viewed through an agent. It was in Middlesbrough and they were going through legals. They'd had the offer accepted, and he asked us to go and have a look at it as he was based in the south and wanted our team to go and look at it and quote for the refurb. So our team went along, and I remember having a conversation with our builders who were pretty strong, tough ex-army people, and they actually said that they were scared of actually getting out of their car in that area. It was that kind of rough. And then when they went inside the property was full of needles. It had been used as some kind of squat, and there was no boiler because the boiler had been stolen. The back door had been kicked in to allow people entry. And obviously we fed all this back to the client, and he ended up pulling out of that property because of those conditions, and was very thankful to us for our honesty and obviously recommending that he didn't buy there. And that is the flaw of buying in the wrong area. I imagine he had bought that property, the potential costs, significant costs that would have burdened him with in terms of the refurb and the potentially issues with tenants or lack of tenants. Who wants to live in that kind of area where it's full of people squatting and crime and drug? It's not showing much potential for growth in the future. It's certainly not a particularly desirable area for anyone to really live. So you can imagine the issues that would have cost him. So he was lucky on that one, and that could have been a lot worse in terms of the impacts on him and tying up all of that capital in that property, which have only caused him pain and likely quite a lot of money. In order to not get burnt buying a property, any property in general, but particularly these cheap properties in bad areas that we've been discussing, it is fundamental that you do thorough research and due diligence. By doing online research will tell you everything you need to know about the area and whether it is a good or a bad area without you even setting foot in it and without leaving the comfort of your own home. You should be able to find its previous adverts for when it was being sold. How much change has there been inside the property? How much investment has been given to it by its previous owners? Be able to understand the local property market and its prices. Has there been any growth over the last 10 years in the area? What's the typical value of a property in the area? How does it compare to the one that you're looking at? And you should be looking at the streets surrounding your property. Are they high value or are they low value? Sometimes it can be really misleading. You might get a posh street next to a low value street. You might get a posh street next to a council estate, for example. That often happens in London, so it can be quite misleading. So you need to ensure that you're doing deep due diligence to not be misled and think that your property is worth $1 million if it's next to a posh area, but you're actually looking at a council house. So you need to ensure that you're also comparing like for like. So looking at this a bit further, there are a few things that you need to consider when you're analysing a property and a location to understand whether it's good or whether it's not a desirable area to be investing. So these include the population growth rate. Obviously, if the growth rate in the area is going up, it means more people are living there and having families there, which is obviously a good sign. If it's decreasing, then you know that actually more and more people are moving out of the area, which means it's in decline. Is it a buzzing high street or is it lots of boarded up shops? Because that will also show how much investment is going into that area and how attractive that area is for people to come and shop. And you can find that out from looking at Street View, Google Street View, and also looking at local papers and local websites, including Facebook groups, to get a picture of what retail shops and how attractive are those retail shops to the locals. Are there any rundown properties or boarded up properties on your street or in the local streets to the property that you're looking at or the area that you're looking? You can again use Street View for that, because if there is boarded up properties, it means there has been abandoned properties, and they firstly devalue the other properties around it, but then make those streets and areas less desirable to live, because essentially they do attract, in that example I mentioned earlier, like squatters and things like that. So no one really wants to live next to a boarded up property because it shows a lack of care about that area too. You want to understand the crime rate and how that compares to other areas. Where are the highest crime locations and streets within the town or the city or the village that you're looking at? You can use a website called Street Check to tell you that. And Street Check's a really great website because it has lots of information, and a lot of these points that I've mentioned, you can find all of the information on there. What's the school quality like? Everything is rated these days, so every school will have a rating by Ofsted, and if it's got a good Ofsted rating, it will attract people to the area, so that will increase your rental desirability as well. So do look on the Ofsted and government websites for school ratings. What's the council's master plan? So the master plan is the council's vision and project plan essentially for investment and regeneration of an area and where new housing is going to be built and targeted. So that is public information and can be found on the local council website. So do go and look at that, about which areas they are targeting for investment, because they are going to be the up and coming areas in that local vicinity, because they're the ones that are benefiting from that investment. And look at what regeneration and investment is going on in the area that you're looking at or is planned for the future. There are a number of websites, and local papers online, of course, are a great resource for looking at what regeneration and investment is planned. They will obviously run stories on that. And in a slightly bigger sort of towns and cities, they will often have a investment website, and that is normally run by a local body which is trying to attract more regeneration and investment into that area. And that will show what investment is planned and also reasons for investing in that area as well. So it will really try and show off an area so you can get a good feel about where the hotspots are. So all these points that I mentioned, and there is lots more, are all going to be indicators of either that the area is growing and being regenerated, so therefore you're getting into that early, or they are going to be an indicator of desirability to rent. And then all of this is on a positive or negative, because obviously if you've got a high crime rate, that's going to probably mean that it's not a desirable area to be renting and to invest. Obviously if you've got a low crime rate, for example, then that is going to be a safe area, which is then going to attract families, for example, and that means that is going to be a good area if you're targeting families to provide them with solid rental homes. So you need to understand each of these points to then analyze whether the area that you're looking at is actually a good or a bad investment area, and where it lies on the scale that I mentioned earlier and the classification of those different areas, and ensure you're doing a thorough level of due diligence before jumping into a property. So I hope I've explained today why you shouldn't just jump into a property which is cheap, even if it has got a high yield. It can really be a painful experience. It can really burn you as a property investor, and it might even put you off property investing for life, and that is certainly not what we want to happen. So in summary, even if you do see a property for £1 or even £10,000, ask yourself, have I done my due diligence? Is this a good deal? What area is this in? Because you might get lucky. You might actually get a great bargain property for £10,000. I mean, we've bought a property for £39,000, and that was a great deal, but that's because we had done our thorough analysis, knew the area, and had done all the checks that I've kind of mentioned today. So there is great deals to be found out there, but don't just dive in without doing any of the research that I've mentioned today. So make sure you're utilizing all the resources and online to do thorough analysis so you don't get burnt. If you're enjoying this content, please do like and subscribe to our channel, because it really helps us to grow, and we really appreciate the support. Thanks very much.